Good morning, everybody, and welcome. I'm Cathy McDermott. I'm the Chief Operating Officer of the Property Council of Australia. It's my great pleasure to welcome you all here today. This is becoming a regular event on our calendar, the virtual briefing from our ANZ Property Council Confidence Survey. And it's great that we have over 200 people tuning in today. I'm joining you from Brisbane. So I would like to acknowledge the traditional custodians of the land on which I stand, and that's the Turrbal and the Jagera people. And I'd like to pay my respects to their elders past, present and future. It's great that this virtual event is something that we're really building upon quarter by quarter as we return to what is going to be our new normal. And it feels like particularly a new normal in Brisbane as the last of our snap lockdown restrictions were lifted at 6 a.m. this morning, and we are now mask free. So that's a very good feeling for us in Brisbane today. This is a very special milestone also in the history of the ANZ Confidence Survey with the Property Council, in that it marks our 10th year. So I'd really love to thank ANZ for their tremendous support in building and creating what is a very important industry resource. It's a great pleasure working with the ANZ team, in particular David Plank, he's the head of Australian Economics, and of course Felicity Emmett, senior economist with ANZ. And so thrilled, Felicity, for you to be speaking today. Felicity and David speak for the Property Council around the country, and they just give us such a great snapshot and insights of where our local markets fit nationally and very importantly globally, and a sense of that real time of what's happening on the ground. And I'd like to acknowledge and thank Russell Martu, Managing Director of RCP, and his tremendous team there. RCP have been long-term supporters of the survey for the past 5 years, but they have been even longer supporters of the Property Council across the country. So thank you, Russell, very much for your support and the support of your team. I know just how much the Property Council and our members appreciate that. Just a bit of housekeeping. What's going to happen today. Felicity is going to do a snapshot of the survey, and then we're going to do a question and answer Q&A. I've got lots of questions and I can't wait to get into it, but we'd also love you to ask questions, and we've got a Q&A facility, so please send through your questions. There's a lot of things happening. We saw a lot of coverage today on the survey, but also the big spike in consumer confidence, and of course the labour force numbers coming out later this morning. So plenty to talk about for a really lively and timely conversation. So I'm going to next hand over to Russell and look forward to a really dynamic and interesting conversation this morning. Thanks, Russell.
Thanks, Cathy. As Cathy said, I'm the Managing Director of the Project Management and Programming Consultancy, RCP, who are the supporting sponsor to ANZ as the lead sponsor for these quarterly surveys. Today, we're joined by Felicity Emmett, who is the Senior Economist from ANZ, and Cathy, who was just speaking, Chief Operating Officer from Property Council. Further to the press releases today in the national papers about the results of the survey, we're pleased to be able to bring online this event for the Property Council members throughout Australia. To better understand the results of the survey, we have Felicity Emmett from ANZ, who will provide her insights into the analysis on the Australian property industry and its sentiment and the broader economic outlook at a national and at a state level. RCP is pleased to have been a supporting sponsor for the survey for the last 5 years, and we continue to see the great benefit and insights which are represented in the survey results each quarter. It is a truly fabulous set of data that we obtain through Property Council and ANZ. The format for today will be Felicity to present her findings from the survey and share her views on the impacts on our industry and on the broader economy. And following Felicity's presentation, we're delighted that Cathy McDermott is available to facilitate the discussions and take questions from participants regarding the presentation. We're scheduled to wrap up in about 45 minutes, so I'll now hand over to Felicity to run through her presentation.
Thank you very much, Russell, and thank you, Kathy, as well. You know, I feel very honoured to be a part of this survey, and I'd echo Russell's comments there that we get so much great data from the survey that we just can't get anywhere else. So we should have some very good insights for you today. And which is good news, is that property sentiment is actually at an all-time high at the moment. So, you know, this is consistent with what we've seen over the last sort of few months, where we've seen a much stronger than expected recovery in the economy more broadly. And when we look at where we are in terms of GDP and unemployment, we're certainly in a much better position than we thought we'd be this time last year, or even sort of in August or so last year, when Victoria and Melbourne was really stuck in that extended lockdown. So you can see from this chart that we have here, the first chart, this is overall property confidence, and at a record high. So really good news there. And the next chart shows the split between residential and commercial. So really what we're seeing at the moment is residential is a really important driver. Property confidence there really well above the previous high that we saw in 2013. But we can't forget too that commercial property is still actually in aggregate looking pretty good, or sentiment is. You can see there we've certainly recovered nearly all of that downturn around the pandemic, and the outlook is looking very positive. Not at the record highs at an aggregate level that we're seeing for residential, but certainly looking very positive about the outlook. Now, the next chart really shows, I think, what has been the key driver, and this is something I mentioned before. So this chart shows economic growth expectations, again at another record high. And I'll just say now, I'm going to say that a lot today, because this survey has lots of different indexes, there's lots of different ways to cut the data, and what we have seen across so many different metrics is record highs in the March survey. So here, economic growth expectations, the highest they've ever been in the history of the survey. And this is really, you know, one of the questions that I've already had about the survey is, oh, is this real, or is this just like some sort of recovery sort of rebound, and it's not going to be sustained? And it's very possible that this ends up being the peak, but I definitely think it's real. When we look at our expectations for economic growth in 2021, we're expecting growth of 4.8% on average through this year. And that is the highest rate of growth that we've seen since the 1990s recovery, in the early 1990s. So it really is, this is we're expecting a very strong recovery. Most economists are expecting very strong growth this year as we continue to recover out of the COVID downturn, but also as the stimulus that's in the system really flows through, and that's fiscal stimulus, which we're still getting, even though things like JobKeeper and Home Builder have finished off. There's still a lot of impetus from that earlier stimulus. There's also other measures that the government has announced, particularly around investment incentives, that are helping to support the economy more broadly and help, you know, really recover, so that GDP growth can continue to be quite strong and bring that unemployment rate down. So here you can see a net balance of 50% of respondents expecting the economy to expand over the coming year. And when we look at the various states and their expectations for their own state economic growth, they're at record highs in New South Wales, Western Australia and the ACT, and very close to record highs in the other states. So definitely, I think this economic growth recovery and expectations for strong growth this year are a key thing underpinning the strength in property sentiment. Now, the next chart shows some of the residential property indicators. Now, as the earlier chart showed, there really is an enormous amount of optimism in the residential sector, and that's very clear with what we're seeing with prices at the moment. So if we look at those indicators, you can see that prices, staffing levels, and the forward work schedule are all at record highs. Construction outlook is close to it, but not quite beating those highs that we saw in 2015 when we saw a very strong apartment building boom. So this is really promising for the residential outlook, and builders have a very large pipeline of activity given the strength that we've seen in building approvals over the past year or so. As I mentioned, this is largely concentrated in house building because of the way the home builder stimulus has worked. But what we are seeing at the moment when we look at things like housing finance is that we're seeing a return of investors into the market, and that will likely at some point translate to a little bit more strength in the unit market. Houses and units should both be benefiting from the very low rates that we have at the moment. And for residential, while home builder has been a key driver of the strength, very low interest rates and the prospect of them staying low for a long time is certainly helping on the prices front. People can borrow a lot more now that we've seen such a large decline in mortgage rates, and so that is bringing people to the market and pushing those prices higher, and that's likely to continue through most of this year, we expect. Now, the next chart shows a state breakdown of those expectations around prices, and you can see there again record highs there, record high price expectations across all states. So, very, very broad-based strength there on the prices. And there's really not a lot of difference there. You can see, South Australia is the strongest, but even Victoria has very high price expectations for the housing sector. And this is something, Victoria is definitely lagging in a number of these indicators. They're certainly lagging in terms of their overall recovery and labour market recovery, and that's due to that extended lockdown. But here on the expectations around prices, they're certainly doing very well. And I think that highlights the fact that the key driver for prices at the moment are these low interest rates that everybody is seeing around the country. So very positive outlook there. And the next chart shows a breakdown by state of the construction outlook. And we do have actually quite a bit of variation here in the housing construction outlook. It's still all quite positive, as you can see, but if you look at those bars around Western Australia, South Australia, Queensland, they are really very positive. Around 80% of respondents saying that they expect a expansion of activity. Now, that is particularly high when you consider that apartment builders haven't seen this boom in construction. So in those particular states, though, there would be a smaller share of apartment builders and a larger share of detached home builders. So on average, they're getting more of a benefit from things like home builder. As well, in some states, particularly WA, the state government offered extra grants for home builders, and that has really helped to build that pipeline of activity. But even in New South Wales and Victoria, we're seeing, really quite a solid outlook for the resi construction pipeline, and that is good news for those economies there. But overall, 61% of people in the residential sector expect that we'll get expanding construction this year. So very good news on that front. The next chart that I've got there is around the pandemic, and this is really more apparent, this impact in the commercial sector, particularly the lingering impact. You can see there that there is still a very significant impact. This question is around the impact so far. So not surprisingly, most respondents are saying that they have been impacted. 91% of firms say that they've been impacted by the pandemic. What we are seeing though is that the number of businesses saying that they're very seriously impacted and it's affecting their business viability has fallen away, and that's now down to 1.4% from a peak of 10%. So that is very good news on that front, but there are still quite significant lingering impacts, and that's much more apparent in the commercial sector than it is in the residential sector, which has seen really had the benefits of more government support, but also haven't seen some of the more longer term headwinds. So if we look at the next chart, we can see what respondents are saying about which sectors they think are most impacted. Now, right from the start of the pandemic, the majority of respondents saw that the tourism sector was going to be most heavily impacted. What we saw, though, over time was that the proportion saying that it would be tourism most heavily affected was declining, and the proportion saying commercial office would be most negatively affected was rising. Retail was another area where there was quite a material impact, but it has been relatively steady. In the latest survey, though, we saw a real uptick in sectors most affected by the pandemic, being tourism. So, and that is clear. We'll see, I've got some more detailed tourism charts, or another one further down, and we'll see that. I think, you know, what we've seen is perhaps a reassessment. The last survey was done in late November, finishing off on, I think, about the 3rd of December. This one was done in March. And so since then, we had the outbreak in Sydney in December. We had a number of state border closures. We had holiday plans, Christmas plans cancelled all across the country. We had Victorians not able to get back into their state. So I think those repeated state borders closures that we've seen have really affected the sort of longer term outlook for tourism, as well as the slow rollout of the vaccine. Now, we've had the announcement just in the last week or so about AstraZeneca, but even before that, it was clear that the rollout was delayed, and that obviously has implications for the eventual reopening of international borders. So I think there has been a reassessment, and on the positive note, fewer people think commercial office will be the worst affected. And that's also apparent when we look at commercial office sentiment more broadly. And the next chart shows the breakdown of all those different commercial property sectors. So you can see there, industrial is really leading the way. It has been the biggest beneficiary, in a way, of the pandemic, with the move to online sales and the strength in wholesale and logistics there. It's really helped industrial property and looking very, very strong there. And when we look at, I don't have a chart, but when we look at all the industrial property indexes are very positive around prices, construction, forward orders, staffing. It's a very positive outlook. But you can see there the other areas, retail, office, tourism, have picked up. They're back above that 100 level. So that means there are more optimists than there are pessimists. And we saw an improvement in the latest survey in both office and retail sentiment, which is very encouraging, but we did see that decline in tourism sentiment. So that is a little bit of a concern. So the next slide is my last slide, and there's a couple of things I want to say about this chart. So this is a chart of all the tourism property indicators, and you can see there the decline that we saw in overall tourism property sentiment was driven by a change in the outlook for capital values and construction. When we look at staffing levels and forward work schedule, that actually increased for both indicators. Now, this is something with the PCA survey. These questions around forward work schedule and staffing are asked about the firm's own business. So that question relates to what firms are seeing themselves on their order book and their hiring intentions. The other questions, prices and construction, is about the industry more broadly. So you can see there in the tourism sector that actually firms feel pretty positive about their own employment levels, their own forward work schedule, they're feeling quite positive about. But when they think about the industry more broadly, they're quite concerned. This is a theme that we saw across much of the commercial property indicators in the recent survey. Firms are confident about their own business, about what they're doing, but they're actually quite concerned about the industry more broadly. And in a way, that's probably a good sign, and I think it suggests that there is some sustainability to the overall positive tone to the report, because if businesses on their own are doing well, the industry should do well. So I think, you know, we can break this down in lots of different ways, and there certainly are some headwinds lingering from the pandemic, but overall I think the signs are very positive for the property sector more broadly. And with that, I'll hand back to you, Kathy, for the Q&A session.
Thanks, Felicity, and what a great navigation through all those results. And it's wonderful to see that confidence, and as you say, even the moderation and rise in confidence around our commercial and our retail and that personal business confidence. So a great capture. Thanks so much. And I have the lovely opportunity now to ask you more questions, and also just what, you know, the house view of ANZ and what ANZ's seeing on the ground, you know, where it aligns or maybe differs from some of these figures. So I'm just going to start, like, when we look at it holistically, the survey results, where do you see the standout opportunity, and where do you see any potential watch outs for us as an industry?
Yeah. Clearly, like in housing, there's, you know, enormous pipeline of activity there, and very high expectations for prices. But, you know, our view is that those high expectations will probably be realised. We're expecting residential prices to rise 17% through this year, given this environment of very low interest rates and the likelihood that they'll stay low. So definitely on the residential front, it is looking very positive. There are, as I mentioned, there are definitely headwinds around the commercial outlook, and they are, the concerns about those are likely to ebb and flow as we get more news about the vaccines. Hopefully, we'll see fewer and fewer state border closures, and that will help certainly with tourism. But really, a lot of the economic recovery more broadly and property sentiment is going to be dependent on that vaccine rollout, not just in Australia, but around the world, so that we can reopen our borders and bring tourists and migrants back to the country.
Thank you. And what do you think the rebound's going to look like? Are we going to see, it's going to be like a wave-like, or is it going to keep its steady climb and confidence, or it's going to be bumpy? What's your feeling? You've got your strong expectation of the economic growth for the next year, but if we take a longer horizon.
Yeah. Look, you know, we really have, what we've seen is a real V-shaped recovery. When we look at what growth has done and when we look at sentiment, it really is that very strong V. And, you know, I think there's a, you know, it's very difficult to forecast sentiment. But when we look at what's happening with growth, it's probably, in terms of annual terms, it's probably going to peak around the first half of this year when we lose those really big negatives that we got in the first half of last year, and they fall out. So, and then I think, you know, the fiscal stimulus impact will start to fade. Resi will likely moderate in the second half of the year and in 2022. And so we're probably close to the peak in sentiment, I would expect. But I don't expect that we're going to see, you know, a real deterioration there, but more of sort of a moderation, given that the outlook is still very positive. We're just not in that really strong growth phase forever.
Yeah, and I wanted to just do a greater exploration by sector, because as you highlighted, you know, we've got the very record confidence around the growth in industrial and housing levels, and they're quite extraordinary. We've seen the office sector and retail concerns about that easing, but the retail and hotel weak. So does that sentiment align with ANZ's view and what you're seeing in the markets across the country?
Yeah, look, it does really align with what we're seeing. I've got to say, though, you know, the way we look at things are very much influenced by the PCA survey. There is so much information that we get from it. So that is certainly a very large source of information for us. But yes, it is consistent with what we're seeing with some of the other information that we're seeing around office occupancy and return to work. It's improving, but it's still got a little way to go. CBD traffic, CBD occupancy, vacancy rates, it's consistent with all of those. So I think that, you know, what we're seeing in the Property Council survey is really consistent with ANZ's view across the sectors, and that, you know, there are some sectors that are going gangbusters and some sectors improving but still headwinds.
And housing always gets the headlines, and we see those auction reports every weekend, and your, you know, growth prospect for the year ahead. We all recognise that housing supply and affordability are the key issues, and that we're working with government to tackle. What responses do you see the RBA or policymakers likely to implement in the coming year? What should we be expecting?
Yeah, look, you know, the sorts of price growth that we're expecting, I think, is likely to be a concern for policymakers. In terms of housing affordability, that's really an issue for state and federal governments. And the survey shows that that's what respondents think. They think that the biggest issue for the state government is housing affordability, and the second biggest issue for the federal government is housing affordability. So for the Reserve Bank and the other regulators, they look at it through a different prism. They're really thinking about lending standards and financial stability. So with a very large increase in prices, you are likely to see some easing of lending standards. And I think that will likely prompt the RBA, excuse me, APRA and the other regulators to step in by the end of the year to slow lending. That in turn will slow down the increases in prices and certainly help on the affordability front. It's actually, though, really difficult in a very low interest rate environment to have too much of an impact on asset prices. This is how this easy monetary policy works. It generates increases in asset prices so people feel confident to spend more. It's just, what it does is it creates this inequality in terms of wealth and intergenerational inequality, and that's really something for state and federal governments to look at ways of addressing.
And that relates actually to a question we've got from the audience around, do you see any feed into the build to rent sector, that this will be an area that there's going to be heightened activity linked to what we've just been talking about, that accessibility idea?
Yeah. Look, I think this is certainly getting a lot more exposure, build to rent. I think we need probably better frameworks set up by the state governments to help to encourage build to rent. But in Australia, we've got a situation where at the moment, the rental stock is all held, or virtually all held, by households, and that is part of, I think, the problem that we have here around lots of issues with rent. So build to rent is definitely getting a lot more focus, as it should, and I think it will take some time, but hopefully that will help to ease some of the issues around broad housing affordability for people, particularly in the capital cities.
And that housing diversity that we're always striving for. Another question from the audience is around the staffing levels sentiment and how positive that looks across the survey. And the question is, how does it relate to employment figures, which is of course a very timely figure with the ABS figures stats coming out in half an hour. So
yeah,
what's your expectation?
Yeah, so a couple of things I'd say there. Again, I'd highlight the fact that staffing level, the firms are responding and saying their staffing levels are high. Expectations are that they remain quite high, even in areas where the outlook, the price and construction outlook for the industry is a bit lower than others. So I think that's quite encouraging, but it's totally consistent with what we're seeing in the broader employment market. So unemployment's now fallen on the February numbers. We get March numbers today, fallen to 5.8%. We expect another sort of small tick down in the numbers later today. But, it's been an amazing recovery in the labour market. Many people, the government as well, are expecting a peak closer or above 10%. The peak ended up being about 7.5%, and the recovery has just been phenomenal. And when you look at what's happening with things like job ads, they are well above pre-pandemic levels, and certainly suggesting there is quite considerable labour demand out there. Whether there might be some friction because of skills mismatch, especially with the borders closed, I think is possible. But we're really seeing that very strong recovery in the labour market come through. And, it's clear in the construction sector as well, that's coming through as well. So it's totally consistent with what we're seeing more broadly.
There's a question from the audience again about the heat in the resi market and the sustainability of it, even with a 1.5% interest rate lift in the medium term, and they're saying 2 to 5 years. Surely that would trigger a correction in pricing. So would it be a downward, would it be correction, upwards? What are your thoughts? And what do you think about that sort of level of 1.5 increase?
Look, it's difficult at this stage. So the RBA has said that they will keep interest rates on hold for until 2023. It's possible that they have to hike before then. But we also need to keep in mind that it's not just the RBA doesn't set mortgage rates. The banks obviously set them, and there's a few things that affect them. What we've seen in the current environment is a very strong switch out of variable mortgages into fixed rate mortgages, and that's because fixed rate mortgage rates have fallen at about twice the rate that more variable rates have. And so in the latest numbers, nearly 40% of people were going into fixed rate mortgages. Now, part of the reason for the decline in fixed rate mortgages was the RBA's term funding facility, where it made available $200 billion for the banks to lend. Now that ends on the 30th of June. And so over the next few months, the bank's funding costs will rise after the 30th of June. And that means that they will probably charge more for fixed rate mortgages. So we don't really need to wait for the RBA to start to hike interest rates. We're likely to see increases in mortgage interest rates in the second half of this year, mostly in fixed rate mortgages, and that will also help to slow the market down. I don't think it's something that is going to lead to price declines by any means, even though in the context of very low rates, there could be quite significant increases, sort of 40 or 50 basis points, but rates will still be quite low by historical standards. So I think that you'll get some impact there, but not enough to really turn the market around, just enough to slow it.
Felicity, I was really interested when you were talking about, and this is a bit beyond the survey, but again, focused on residential, when you're talking about building approvals and the units and the housing and the investors returning to the market. So can you just shed some more light on that and elaborate on that? I think it's very interesting, you know, when we're still looking at where is the clarity about when we can safely open our international borders.
You know, this has been very interesting, what we've seen. So in the housing finance data, it was really largely initially driven, the strength was driven by owner occupiers and in particular first home buyers. That's where we really saw that early strength. But investors were really still, new finance for investors was still quite weak for a while. And keep in mind too that they're also coming from a much lower base. Investor finance really as a share of overall finance has been declining since about 2015 when APRA first introduced macroprudential controls to slow that part of the market. So when we look at investors as a share of the market, it's still quite low, but it is starting to pick up. And, you know, over the last 12 months or so, actually investor finance has grown by about 30%. So they're definitely returning. Now, investors have much greater tendency to buy apartments. And so there often is this very strong link between what we see in investor finance and what we see in apartment approvals. Now, so far, there's no really clear or material pickup in unit approvals. And the unit market does face those headwinds from low immigration or no immigration. But I think what we will see over the next year or so, we will start to see, I think, a pickup in the apartment market. It won't be as strong as what we've seen in the house market, but certainly I expect that we will see some improvement. It is still benefiting from those very low interest rates. And also I think developers are going to be conscious of the fact that eventually the borders will reopen, we will get a return to migration growth, a return to stronger population growth, and we will need houses, and apartments have long lead times. If approvals don't start to pick up soon, then we'll, in a couple of years' time, when the borders are open, there will be issues around housing shortage. So I think that from where we are, we should see some improvement over the next year.
We're coming to the end of our Q&A session. I've just got one question to round out, but this is your opportunity to throw in some questions from the audience if you would like to put them under the Q&A session. What I wanted to ask you about, Felicity, is the CBDs. So, you know, we saw a lot of concern about it in earlier surveys, but that is now moderating. We're seeing workers return to their CBDs, something that the Property Council and our members and governments are working very closely on. And I just, you know, we had a recent report around CBDs with EY, and it was very interesting that while people want to retain an element of flex, 82% of respondents are very confident that the CBDs are going to evolve into green and exciting places, and they really acknowledge, you know, the benefits of collaboration and the social interaction with their colleagues. I wanted to ask you, what do you see as the post-pandemic initiatives we're going to see in our CBDs?
Yeah, look, I think, one of the words you used in that discussion was evolve. And I think that is really something that CBDs will do. We are seeing that return to work. Certainly, I'm based in Sydney. When you walk around the CBDs at lunchtime, it feels very busy. It's missing some of those international tourists, but it certainly feels busy again. And in offices, people are definitely coming back. But we are going to see more people working from home on a permanent basis than we saw pre-pandemic. So I think that CBDs will evolve. People, still want that connection with their workers. They still want to go out to lunch and out for a drink after work. But, there may not be the same level of demand in retail, for example, as we saw prior. So I think that what we're going to see, I'm sure we'll see thriving CBDs in the future, but there will be a process of evolution to adjust to some of these longer term challenges that the pandemic has thrown at us.
Thanks, Felicity. That brings us to the end of our Q&A session. So before I hand over to Russell to round out and close up the today's event, I'd like to again thank ANZ and RCP for their support, and also to our Property Council research team led by John Ewan, who put together the survey every quarter. I'm very much looking forward to our next survey to see where to from here. And also celebrate our milestones together. So it's my great pleasure to throw back to you, Russell.
Thanks, Kathy. And look, thank you everybody for your time today to be part of this discussion. It was certainly a great opportunity to hear firsthand the in-depth analysis behind the headline data that has been made available through the survey. Big thank you to Felicity for your great presentation and your detailed commentary. And also to you, Kathy, for an excellent job as a facilitator for our discussions post the presentation. I'd also like to thank all the participants today. As we said, we've got a large number of participants nationally online today for taking the time to be involved in this event. And I trust that you've gained a greater insight into these current issues. Also, a big thank you to the team at PCA for their hard work in putting together an event such as this. There's certainly a lot of work behind the scenes that is done to make the event run smoothly, and I'm sure everyone will agree that this time is well spent to support the members of the Property Council of Australia. So in closing up, have a great day. I look forward to talking to you all in the near future. Thanks so much for joining us.
Thank you.